Hi, this is Rick again. Welcome to the first session of the SBV Academy online entitled Don't Get Even, Get Ahead. Now, when you enrolled, you made an initial investment of $497. And as we all know, the first rule of investing is to get a return on your investment as quickly as possible. Now, remember, we're not here to sell products and services or to get in on some ground floor opportunity with the next big thing. There are lots of other places you can go to find that. My approach is to focus on creating new cash flow from the most reliable source of income there is, your own money. Now, by the end of this lesson, you will know how to bring home more money in your next paycheck. More than enough to cover the cost of this program and to pay for it again many times over within a year. Now, that's my idea of return on investment. And that's how you don't just get even, you get ahead. Now, did you know that 80% of Americans overpay their taxes every year? Hey, I don't make this stuff up. It's right there in black and white on the IRS's own website. Now, as much as we complain about high taxes, most of us regularly pay more than we have to, simply because we don't understand how taxes really work. Now, our tax system is really quite simple. Uncle Sam takes what he thinks he needs to run the country from your paycheck. And let's be clear, he always takes more than he needs, just in case. Then he just sits back and waits for you to file to get it back. Now, he knows that most of us won't even bother to come back for it because we don't know how, or are too intimidated by the IRS to do so, even if we did. So how do you know if you're one of the 80% who overpay their taxes? It's easy. If you get a tax refund every year, then you're one of them. You probably think a tax refund is a good thing, but it's not. Confused? Let me explain. The very nature of a refund indicates that you paid too much in the first place and that you have money coming back to you. Why would you overpay on purpose? And once made aware, why wouldn't you stop doing it? Well, apparently that's not the case. We seem perfectly content to loan Uncle Sam our money, interest-free for a year, and then pay taxes on it when we finally do get our refund. Now that's crazy. But before we go any further, can we agree on one thing? You are not a bank. If you were, you'd probably do a much better job of charging and collecting interest on money that you loan out. Maybe you didn't know you were in the banking business, but in a very real sense, you are. Think for a moment about how a bank makes its money. When you put your money in a bank, it doesn't just sit there. The bank uses your money to pay its bills, lower debt, and invest. By the way, this is the same thing Uncle Sam does with your refund money and what you should be doing with it after I show you how to get it back. The bank then invests your money with a money management company and earns 8% to 12% on it, and then pays you only 1% to 2% interest. Welcome to First Suckers National Bank. The banks and Uncle Sam are both getting rich off your money. Shouldn't you be the one getting rich off your money? Okay, we've played enough Ain't It Awful for one day. Now let's go get your money back. The first step to getting out of the banking business and into the self-investment business lies in that simple document that you filled out when you got your first job at 16 years old. It's called the IRS Form W-4, and 80% of Americans fill it out incorrectly, causing them to overpay their taxes by thousands of dollars each year. By simply correcting your W-4, most people will increase their take-home pay by $200 to $400 a month, instantly. Now, could you use another $2,400 to $4,800 a year in your life? Well, I'm betting you can. The key, though, is in what you do with your money when you get it back and how you avoid giving it away in the future. You should do the exact same thing that Uncle Sam and the banks do with your money. Pay bills, lower debt, and invest it. For goodness sakes, don't just buy stuff with it. Later on, I'll explain why not when we cover how to buy assets instead of liabilities. Now, when you were 16 years old, starting your first job, you had to fill out your first Form W-4. You probably asked the lady behind the desk what an allowance was and how many do I take. She no doubt told you just put down 1 or 0 so you won't owe any taxes at the end of the year. Now that may have been marginally good advice at 16, but it's lousy advice now. And many adults still blindly follow that lousy advice to this day. Now I say this because the W-4 is a living, breathing document. It should change as events and situations in your life change. Again, this is not just me talking, but the IRS itself. Referring once again to its website, the IRS recommends that you adjust your W-4 regularly for events such as marriage, divorce, birth of a child, death of a child, getting a new job, losing a job, etc. Now, I can't throw stones here. I didn't change my W-4 for over 20 years because I just didn't know any better. Well, now I do. Much of the problem stems from the fact that most people don't understand the difference between an allowance and a dependent. Now, they're not the same, and the W-4 primarily focuses on allowances. An allowance is simply a mathematical calculation that determines how much money will be withheld from your paycheck by your employer. The number is not set in stone and varies with each individual and their unique set of circumstances. It's up to you to figure out how many allowances to claim so that you don't overpay your taxes, but at the same time won't owe taxes at the end of the year either. In plain English, what that means is that as your life situations change, so should the number of allowances on your W-4. Now think about it. Has your life changed in the last few years? When was the last time you adjusted your W-4? Now you may want to consult with your tax preparer on the specifics though. In the end, filling out your W-4 correctly comes down to just two things: reading the instructions and answering the questions. It's really just that simple. Let me show you what I mean. Meet Mary, a single parent, head of household, with one job, making $50,000 a year, and has 2 kids. Now she claims 3 allowances on her W-4, one for herself and one for each child. She claims 3 allowances simply because she doesn't understand the difference between an allowance and a dependent. And once again, the lady behind the desk was somewhat less than forthcoming with a helpful explanation. So Mary does what she knows and subsequently costs herself thousands of dollars a year. Now remember, before Mary enrolled in my SBV Academy online, she was only claiming 3 allowances on her W-4, leaving thousands of dollars on the table every year, dollars that she could have been using to pay bills, lower debt, and invest. So let's walk through Mary's W-4 together and see what she learned. Remember, it's as easy as reading the questions and answering them. Okay, the first question is, enter 1 for yourself. Well, that's a pretty easy one. So she enters 1. The second one is, you are single and have only 1 job. Well, that applies to Mary. So she puts down 1. Enter 1 for your spouse. Well, she doesn't have a spouse, so clearly nothing goes there. Enter number of dependents other than your spouse or yourself that you'll claim on your tax return. Now we know already she's got 2 kids and she claims them, so they go there. Now enter 1 if you filed head of household on your tax return. And you remember, she is head of household, so she meets that criteria. So she gets another one. Okay, now next, if you have at least $1,900 of child or dependent care expenses, which she easily does that, and she will take a tax credit for that. But why wait till the end of the year to get that tax credit? She just takes the credit now. Okay, so 1 goes there. Now, if your total income will be between $65,000 and $84,000, well, we established she makes $50,000. So she can put down 1 for each eligible child. Okay? Or excuse me, put down 2. So that's where we get the 4. Now you just add lines A through G and enter the total here. You add those up. Bingo, you got 10 allowances. Now initially she was only claiming 3. And the only reason for that was because she was taught, claim yourself and your dependents. And that just isn't the way the W-4 works. All right, let's do the math. How much is an allowance worth? This is not an easy question to answer because it varies with the person and the situation. Even the time of year can make a big difference. For example, an allowance claimed in January is worth twice as much as one claimed initially in June because it's spread out over half the time. Now, generally speaking, an allowance is worth between $50 and $80 a month. Now, again, this depends on your circumstances and is only an estimate. For our purposes here today, let's go with $50 a month. It makes the math much easier. Now let's recap the financial impact of the allowances Mary claimed on her W-4. Now, remember she makes $50,000 a year, which in reality is $35,000 after Uncle Sam takes his cut. Now, she claims 3 allowances, which as we said, we're using $50 a month as the estimate for that. So that's $150 a month that she gets back in her paycheck because she claimed those 3 allowances. And that amounts to $1,800 a year. I mean, that's not chump change. But you'll recall when we did the form, question by question, she qualified for 10 allowances. Now that's $500 a month. Now, you tell me you can't use another $500 a month to pay your bills, to get that credit card debt down, to pay some student loans, whatever it is you need to do with it. But that money could be yours now, not at the end of the year in a tax refund. That's $6,000 a year. Now, in reality, because she was going to claim 3 anyway, it's really an additional 7 allowances or an additional $350 a month. But still, that's another $4,200 a year in her pocket that she can deal with. She's not going to get a raise for that much. She's not going to, it's just the easiest way to get good money. And it's your money. Now, while Mary should be very happy with taking back $6,000 of her hard-earned money from Uncle Sam, what about the other $9,000? Is it possible? Yes, it is, but it won't be as easy as simply correcting her W-4. In order for Mary to take back the rest of her tax money, she will need the help of a strategic business venture. She will soon learn to recognize and appreciate the true value and power of the SPV, as will you. It's like being rescued by the cavalry. Now, my time is up, so you'll have to wait until next week to learn more. This is Rick Hopkins, and I wish you the best in financial success.